So welcome everyone. Welcome to this Market Thursday, February the 24th, 9 p.m. here in London. Quickly, disclaimer. So this webinar is not investment advice. This is purely for information. I do not take responsibility for losses incurred by the viewers. So please do your own research before doing anything as usual. So quickly, looking at my background, started to work as a cash equity trader in 2000 in Paris, working for an asset manager in Paris, where we were managing at max 50 million euros. Then in 2004, I joined Griffin Capital Management in London. I worked there from 2004 to 2008, where we had exposure to Western Europe and Eastern Europe. So these days with Russia and Ukraine, it reminds me of how those markets in Eastern Europe could be moving. I remember we had 2 billion. So I was part of the Western Europe, but the other part of this boutique shop was running 2 billion Western Europe. So a lot of Russian exposure, literally 2006, 2005, 2006, 2007. Okay, very good year. Up, the funds were up 50%, and then the whole thing came down massively, very quickly, and it unfolds. So I know how quickly those things could happen. So I'm not. That's not. I mean, I was expecting anything like this, just for the record, but I'm not surprised when I see those big moves. Really, those are the places where you need to be extremely careful. 2009, 2018, Infinity Capital Market doing prop trading. And I rejoined them last year in 2021 in January. Since 2014, I've been mentoring people and retail traders from all over the world. I used to work for another mentoring company that I left in 2017, and we started doing my own mentoring and launched my video series in 2018, 2019. So today, what are we going to be covering? So as usual, we're going to be covering the situation across asset classes, looking at stocks, credit, commodities, FX. And this day has been quite something. Then we're going to be looking at the catalyst moving forward, Ukraine, obviously, which is making the headlines and making the moves. The Fed expectations / inflation, looking at earnings and looking at options. Then, I would like to be discussing options, risk management 101. Because I had many people coming to me recently that suffered big losses. And I know that, unfortunately, retail traders have been pushed into that space, moving some of their exposure and some of their leverage from equities to options. So today, quite something of a day. S&P moved 180 points from the lows, 1,000 points on the Nasdaq. So we are talking 7% move on the Nasdaq, 4%, 4% on the S&P, a bit more, 4.5% from the lows in the morning. So US reacted quite, so was oversold, was selling off in the morning, with Europe coming down. And from the open and a bit before, we started to recover. And we finished pretty strong. So to put everything into perspective, where we look at technical analysis, we price action, we'll see that we are very close to the levels that were on the S&P, on the Nasdaq at 6 p.m. UK time, so 2-3 hours before the close as of yesterday. But really the market yesterday, there was something wrong about it. Felt like really the price action was really bad. So I tweeted like yesterday, really something was not feeling right. So in between we went down 5%. But literally, if you had taken 24 hours in between, the prices are back or even higher than where they were. Interestingly, as well, all the garbage, the ARK of this world, outperformed today quite massively. I think ARK is up 5 to 6%. Many names that have been killed over the last 3 months massively outperformed the market. So As usual, we try to look at the catalyst. So I'm not going to be talking now. It's going to be later. But I would like first to be talking about the price action and how the different asset class performances. So this asset class performances year to date was taken a couple of hours ago, where the picture for the equities is more or less the same, with stocks down between 5 to 15%. With now Europe catching up with the US and pretty much at the same level year to date as the US. So there has been a massive underperformance or outperformance of the US versus the Europe this week. Rightly so, for the reason which is pretty obvious, that Ukraine and Russia are much closer to Europe, and actually Ukraine is part of Europe than this is for the US, and European companies are doing much more business than they are than the US. So that is affecting the European markets. Most European banks were down between 7 and 12%. Or 15%, the names of UniCredito, SocGen, Societe Generale, BNP. So Winnie Financial suffered, but if you look at the US as well, JP Morgan suffered on the day, underperformed the market. So S&P finished up 1%, and I think JP Morgan was down 2%. So that has repercussion already into the financials. If you look at the dollar on the year to date is doing pretty well. Up 1 to 2%. But what is interesting is the gold has been pretty strong for the year. There has been a massive reversal today. So today is the day of reversals. You will see reversals everywhere. So if you are a big fan of reversals, that might be the day. Having said that, a month ago, as you remember, we had this 42.12 lows on the S&P on the Monday after the expiry that we broke this morning, went lower. But what was interesting that we discussed during the last webinar a couple of weeks ago is that the market didn't feel pretty good. We were at that time around 4,500 or plus. And as I told you, that was probably the time to reduce exposure. Actually, this is what I did. I was reducing my gross exposure. I feel like very much that we had to retest the lows. Now, with a day like today, when you get such a big reversal in big volumes, that gives obviously some caution, but we'll see in the next few days how are we going to move. Asset classes week to date, as you know, this thing was done 2 or 3 hours ago. There has been a big change. The Nasdaq is actually almost flat on the week. So that tells you, in other words, the volatility that we experienced today and we experienced over the last couple of months. So the implied volatility is with the VIX was at 30% at the above, but the realized volatility is very high as well. Interestingly, for the crypto guys of this world, Bitcoin didn't play out very well as a safe haven. So Bitcoin suffered on the week. You've seen probably many tweets on this chart of gold in the morning up 2 to 3% and Bitcoin down 3 to 5%. So there was a large dispersion, which makes the old school gold safe haven very happy, and the new generation quite upset. But that is one of the things that we've seen. So year-to-date sector performances and week-to-date, same picture as before. Energy, the only winner, up 20%. Big reversal on oil today. As we're gonna see, we went to 100 on WTI, and now I think we close around the 93. But on the other hand, the 10, 11 sectors all down on the year, 18% consumer discretionary, and on the week to date, again, that was a couple of hours ago, but the overall was a risk off with consumer discretionary, underperforming the overall market. So picture was risk off. It's still risk off, despite, you know, this big bounce or this big reversal on the day. Next page, next slide, looking at the bonds and the VIX. So the bonds, why? It's to understand, you know, this flight to safety. So looking at the US 10 years, we know that yields have been massively up on the year, not only the 10 years, but the 2 years, the whole yield curve has been moving, but because of this safe haven, week to date, yields have been coming down and bonds going up. VIX, now I think it's, let me check, the VIX closed at, where are we? Sorry, my Bloomberg is a bit messy here. So VIX, the VIX closed at 30%. So 30%, 30% tells you, if you look at the rules and how to calculate implied volatility and what is the move expected going forward on the S&P, that gives you roughly a 2% move on the S&P. Okay, today we had a 4% move, so that tells you the realized volatility is just going boom. So VIX at 30%, you can be looking at the past history, but you know, 2 months of 20% plus VIX that we had recently is quite something that tells you about the nervousness of this overall market. What about we jump into technical analysis? If you have some things that you would like to discuss, some stocks that you want to discuss, maybe put that in the chat, and maybe I can help you a bit. So starting with the let me go that with the S&P. So S&P, so that was the lows of, as I mentioned, of Monday a month ago at the 4212 that we broke down, and you can see this big reversal. So important level. Having said that, it feels very shaky. When I look, so that's something that I put in the community of traders. That in the morning I said 2 things. I said that the Europe will probably underperform the S&P. So on that one I was correct, because it underperformed by 3 to 5%. The other one I was not correct so far, which is I think the next level on the downside is 3850, 3900. So if you look at this level, there is a bit of so 3850, 3950. If we go below this 4100 as we've done this morning, I think this is the next level. Why? Because this is where we had a fight, where there is a big some volume on the way down. Looking at the Nasdaq NQ, and here for those of you, I'm looking at the futures, okay, because you can be trading them overnight, and it's the most liquid stuff. So looking at the futures, despite the bounce, it feels very much like, you know, we are in the downtrend. If you think about what is the pen trade, the pen trade in the morning was to go lower. Now I think the pen trade short term is to go higher, because people reduce massively exposure. So the gross exposure has been massively reduced. People like me, many hedge funds, and I think the positioning as well in terms of net exposure long is pretty small. So if you ask me short term, I will say that the pen trade is higher, but mid to long term, I think we have to go lower. We look at the catalyst and how we can reverse those things. So that is for the Nasdaq. Let me check the next one that I wanted to discuss. Yes, I wanted to discuss. Let me go there. Looking at the Nasdaq versus the S&P. I think this is an interesting chart. Nasdaq versus the S&P up. That is the futures. You can see up, we bounce exactly at the same level that May 2021. So that was this morning. If we break lower, you could expect some more underperformance of the Nasdaq. So in terms of intermediate low, there is a strong possibility that Nasdaq will do a bit better than the overall market moving forward. And you saw probably all those dodgy names doing fine. Bit of Europe, because Europe has been leading the pack here and the story. So that is for the DAX here, which is the German index, so the DAX 30, but here we are looking at the futures, something that you saw probably that I tweeted on Monday. We broke the 14,800, so important level. That was the support that we had since for the last year. For any market, you'll be looking for the leading indicator of any market. We knew that the story was mostly about Russia and Ukraine, and obviously the leading indicator of that part of the world was DAX, the DAX. So when the DAX started to break down, and when the Russian index was down 9%, I think on Monday, that was a bad sign, and that was a confirmation. So always trust this price action, because they are good leading indicators. Similarly, if you look at the stock 600, which is the biggest 600 stocks of the in Europe, so we had some support today. We reached some support. So let me give you a bigger chart, and then you're gonna understand where we are in the support. So that was the highs that we had pre-crisis, pre-COVID, that we touched this morning. We bounce a bit, but again, despite this big bounce, feels Europe is not the right in the right place, and will not be following the same pattern as the US. Emerging market, EM, that I want to discuss as well. So something that we've seen before, and I've been saying, you know, we should be definitely looking at this chart. Bonds on this support that we looked at before managed to close above in big volume. So EM was obviously suffering from Russia. So look at the Russian ETF. So this is RSX. We are not so far at the lows of 2020. I think here there has been a lot of pain. The RSX is not necessarily a big ETF, okay, in terms of size. I think the NAV is 1.5 to 2 billion, but what you're going to have is some investors will have been buying this before or pretty early into the 20s, 22. Thinking this is a perfect long based on commodities on oil, because you know you have obviously Gazprom and other names, and in between it went down by 30%. So people get burned here, get burned badly, and it's probably what you know when you're holding this position, it's not going to reverse overnight. So this one there has been a lot of pain. If you look now at JP Morgan, something that I discussed before, just before mentioning the bank. So still so far bouncing on this 140 level, but you can see how you don't need to be a specialist in terms of technical analysis, and I'm not. But the price action is getting worse and worse. Any questions? Again, if you have some charts that you'd like to discuss. Crude oil, WTI. So this is the trend that has been ongoing. We have been trying to move higher. This is some kind of reversal. Again, 100 to 93, so we are talking 7% from the highs in big volume. A lot of if you have been, you know, running a big book, or not even a big book, your P&L between the morning and the close, we are talking many stocks, many assets that have been moving by 7 to 10%. So between the Nasdaq down and up at the end of the day, we are talking 7%. Same with with the oil, gold, where is the gold? Where is my gold? So gold, same huge reversal. So in the morning, if you've been long gold, you've been like partying and thinking, you know, finally my time is coming for gold to go much higher, and then it closed slightly down on the day. In other words, people, when you get pain somewhere and the moves have been so big and you have positioned, very often you don't trade well. So when I said, you know, it's very similar to when you have earnings, when you come with a position and its position goes badly on the day, it's down, let's say 10% on the day. In the morning, when you're long, you'll be panicking, you'll be trading like shit, and it could be ending up flat on the day, and you'll be very upset. And I think this is some of these days where if you came in the morning with a lot of exposure, you struggled a lot. The beauty of Twitter is you'll see that no one was long, everyone bought in the morning, and everyone made a killing. But you should put everything into perspective. Again, the S&P is back to where it was 26 hours ago. The Nasdaq is back to where it was on Friday, and you need to keep in mind that 99% of the world is long only. So those people are really suffering. Finally, euro dollar. You know this chart about the euro dollar. I'm always, because I'm an old man, I'm always looking at the same chart. But so far the trend is still respecting the trend and above the trend. So nothing is really broken. Similar, we had risk-off in the morning and risk-on in the afternoon. But clearly now it's less bullish for the euro. For the simple reason that stress is in Europe now and will stay in Europe for longer. So it's not gonna vanish overnight. We knew that the situation really went badly or accelerated on the way down for Monday. I don't want to go into, you know, a specialist of Ukraine, Russia. That is really a bad day for Europe, and I'm not talking about stocks. I'm just talking, you know, about the pictures about people in Ukraine. So that is a serious bad day, and I think when you're trading those days, it's very hard to sometimes to completely dissociate yourself from what is happening and just trading the price action. What you're going to have is you will always remember those days when you've been trading, the same as, you know, when I traded 9/11, when I started, when you trade the great financial crisis. Those are the big days that you will remember. But overall picture for Europe is going to be a struggle. The beauty of the US is they got this ability of saying, you know, Ukraine is important in the morning, and in the afternoon is, you know, Ukraine is far from us. So suddenly the price action, and what happens is investors, rightly so, for the best assets in the world, so that they will jump for the US. So this is why we've seen. This is why, I mean, don't get me wrong, I don't want to do any back trading and hindsight and telling you, you know, that was an easy day to trade. Actually, normally I trade those days pretty well. Today I ended up flattish. As I've been saying for the last couple of weeks, my view has been, you know, market coming down, reduced gross exposure, but I found still the market very hard to trade. So you could be making a ton, but if you use, as a trader, you'll be using a nice setup where you want to have, where you can identify nice stop loss, or stop loss that are not too far away. What you don't want is enter a position and say, okay, I'm going to decide later where's going to be my stop loss. And I think what is happening when you have move of 7-10%, it's on the day, it's much harder, because there is no I mean, probably to me, and maybe I'm shit these days, but look, when you're shit and you're flat, it's good. Now I think moving forward, I think there will be a better setup. And I think this is why we want to be looking at the next catalyst. No questions so far, so I carry on. So question from Yannick, what is your average time of between entry and exit for trades? I mean, when I started to trade, I started intraday. When I work for hedge fund, I've done up to 18 months, 24 months. So really, I can do from literally 2 minutes to 2 to 3 months these days. These days, because the volatility is so high, I reduced my exposure and I reduced my time frame massively. So I give you an example. I entered Twitter and Facebook, I think it was last week, and I closed today. I closed small flattish. I have some other position in biotech that I've been running for quite a long time. Today I tried to trade Europe, but the moves were just too big. So I think what is most important, Yannick, coming to your question, is to identify the setup where you can limit your downside. Normally, when you're running a portfolio, what you say is, you're going to have a hard stop loss policy, and your hard stop loss policy could be between 7 to 10% for any single position. But really, what we love to do is reduce the 7 to 10% to lower. So you're going to be looking at support. You're going to be looking at some setups that give you a better risk reward. And these days, because the moves have been so high, you're going to be stopped out very quickly. So it's kind of, you get stop, and then you try to be making a big moves. What you don't want to do is running the things and saying, okay, yesterday, I think this market will be fine. And in between, you could be losing 5 to 12%. Question from Damien, do you structure your trades with options as well? I do, not always. So that is something we're going to be discussing later. I think the beauty with options is that gives you the right and the ability to structure the trades with the strikes, with the different strikes. So strikes tell you, allows you to say, my stock is going to be moving by X%. So you can be using different strikes, and you can be using different maturities depending on your catalyst. Okay, so if you're looking at the 3-day stories and say in the morning, I think, Ukraine is bullshit for the US market, obviously you'll be looking at, let's say, Friday's, tomorrow's calls on the S&P. But what is harder these days is because the implied volatility, which is very important with options, is so high. Implied volatility in the pricing of your premium through Black-Scholes is very, very important. So I think, and that is something that I'm going to explain later, is many retail traders get absolutely murdered not understanding the concept of implied volatility, because they come in the market and say, oh, I think the market is going to go much lower, when let's say this morning when the VIX was at 35 or 40%. So that means you're going to be paying a very high premium for something that, even if just the implied volatility goes down, you're going to be losing for a flat market or market, or even a small market down. So options, I do use them. I think this is a fallacy. I think this is a lie to tell retail traders to be using options only. Trust me, I've seen many people coming to me these days. I'm mentoring guys these days that have done just recently mentoring programs with only options. They don't understand what they are doing. They're really struggling. The P&L is negative despite all the noise. And I'm pretty upset about what is happening with these options, people trading too much of options. I hope I answered some of your questions. Michelle, can you ask this question at the end? And we're going to discuss that later. I just want to go through the catalyst now, and please, Michelle, send again your question at the end of this thing. So catalyst, a bit of seasonality. You know, this is something that I like to be mentioning. So where we are almost here. Okay, so instead of being flat on the year, we're down 10%. So the S&P is down 10%. But in other words, what you have is the Q1 very often. The S&P seasonality is not great. It's not I hear you, and I hear some of you saying, it's not because it happened in the past that is why it's happening these days, and I'm with you. But that gives you the pattern, at least, of what has been happening over the last 20 years. So what is going to be key going forward is obviously the earnings, as we're going to be looking. But in terms of seasonality, guess what? Around the 15th of March or mid-March, the market tends to go higher. What happens from the 15th of March of this year is we're going to have the Fed meeting. Okay, so as portfolio managers, as traders, we are looking for catalysts. We know that Ukraine, Russia is big, is making the headlines, bringing a lot of noise. Every single day, we're going to have a noise. We're going to have Putin talking. We're going to have Biden talking. We're going to have, Russian troops somewhere. I'm not saying that I don't care. I really care. I think it's a bad story. It's really a bad day, again, as I say, for Europe. Okay, and I don't want to pretend that we should not be listening to it, but there is a lot of noise into it, and we need to think as well, for our job and for our portfolio, what is. And I'm sorry to say that in a day like this. Okay, I want to put that on the record, but we knew as well that stocks were already weak. Okay, and this weakness started in October, November last year. So in October, November last year, 2021, it was not too much about Russia and Ukraine. So if you look at all those growth stocks that get hammered from November, that has nothing to do with Russia. Okay, so the underlying the price action of the market was already bad, and we had some acceleration on the downside. So looking at the next catalyst, we get the Fed meeting. Coming with the Fed meetings, we get the inflation data. So even if we are all bored about the inflation and it feels a bit like, it's an old news, reality is central banks will have to do something as inflation is very, very strong and too strong. So we need to be looking at the CPI, the PCE, the ISM prices, because those news will be coming every 2 weeks and will be affecting the price action. In the long run, what matters the most for any equity market is the earnings trend. Okay, when earnings are trending higher, normally the market should go higher. You can argue that the multiples of the PE could come down, but in the long run, again, earnings really matter. So those earnings will be the real catalyst in the mid to long term. We still need to be looking at M&A. Why? Because M&A has been very, very strong in 2021. So as long as we see deals happening, I'm talking, private equity, but as well between companies, that means the market and the financing of the market is still healthy. If we see less deals, and if we see, and as well, if the multiples of the deals are coming down, then this is another warning sign. We're going to be talking about the yield curve. And here I'm talking the 10 years versus the 2 years, where historically it has been a decent leading indicator. But with this leading indicator, what is interesting is the timing is not always obvious. We are talking, between 12 to 18 months sometimes. And finally, always looking at what is driving the market, which is, as I said, mostly with options. So the cash has been very often following the options. So we need to know when are the different options expiring. So quickly, Fed meeting versus inflation. So what I put here is the different inflation dates for the next 2 months, with the PCE on the 25th of Feb, 1st of March, obviously you get the ISM prices. So before the next very important Fed meeting, which is where the expectations or the outcome is expected on the 15th of March, we have 4 inflation data. We know that this Fed meeting, there is no probably either 25 bips or 50 bips rate hike, depending if you get to Ukraine or no Ukraine. It's probably 70–80% towards the 50 bips, as we're going to be looking later with the euro dollar. what is the market expecting? Then we get the next Fed meeting that comes pretty quickly as well. So it comes at the start of May. So you only get 6 weeks between the two. And in between, as you see here, you get 6 inflation data. I think really it really matters because inflation is very high. And as I said, politicians have been pushing very hard central bankers to do something. So if you look at the Biden administration, because we have election at the end of the year, they need to act very quickly. They need to act and to show to the US consumer that they're doing something. And that's the same in Europe. In Europe, you get French election coming, and the overall the ECB is under pressure to do something. So in terms of catalyst, Fed meeting, March, 15, May, June. So those are the next 3 months where we could expect, 25 to 50 bips at each of these meetings. And then, as always, looking at the next big geopolitical or elections that we're gonna have. As a French, maybe the outcome is I think is 80% expected. So there's not gonna be much of surprise. Having said that, you never know, but put in your calendar those obvious catalysts. Then, as I said before, what is important for the market? I'm talking here the equity market, which is 80% of my exposure. What has been the trend of the earnings? So here we are looking at how the companies have been beating expectations over the last 7 years. So in blue we get the beat. In yellow, we get the missed, and in gray, how companies have been meeting. So let's go into the next slide, which is going to be a better view. As you can see, the blue line is coming down. It's still above, let's say, historic average, which is around 70–75%, but it has been trending down. So what made the equity market so strong in 2021, as we discussed before, is the US companies have been beating expectations in quite above average, historical average, and quite in strong fashion. But now the trend over the last couple of earnings season quarters have been coming down. So that is really something to watch. If you look into the next slide, which I took from Bloomberg, here we get the S&P sales and earnings growth. Looking at so in this one is for the existing quarter, and we are looking for the following quarters. As you can see, the sales expectations or the sales growth, are coming down. And more importantly, you can see that in terms of seasonality, or I don't know if it's seasonality, but sequentiality, you can see that Q1 and Q2 for the average earnings growth is not looking great. So if you're looking for catalysts, on one hand, you can argue that the market is already pricing shit, but on the other hand, you can argue that the earnings growth in the next couple of quarters is not going to be phenomenal. So it's going to be, if you don't have this driver of earnings, it's going to be very hard for the S&P, for the Nasdaq to be that strong. So the next 3 to 6 months, not much of positivity, and you can see as well that the trend of the sales is coming down, and obviously that gives you the question going forward. What happened in 2023, and what is the GDP growth? So earnings are going in parallel with the GDP growth. In other words, GDP growth is you still get GDP growing in the US and in Europe, but at lower pace than before, and it's coming lower and lower. So next catalyst is the yield curve. So that's something that I found on Twitter, looking at, so I strongly advise you, if you are watching on YouTube, you just pause and you look at this one. or tonight for those of you watching. Maybe watch it later when I put it on YouTube, which is looking at when is the yield curve inverting, meaning the 10 years versus the 2 years inverting. When do we have a recession, and when is the S&P being negative? What happens very quickly is if you look at the first curve inversion, very often you get the start of the recession, which is here. At least recently, for the last, let's say, since the 70s, you get a recession over 12 to 24 months. And very often, 12 to 24 months, you do have as well a bear market, or at least a correction in the equity market. So that is something that is discussed in the 4x4 video series, looking at the leading indicators and what are the most successful leading indicators. Is very often the 10 to 2, the yield curve, the inversion of the yield curve is a very good leading indicator, very good sign that something is going to change. Having said that, the timing is pretty hard. So if we go back into the chart here, and let me show you where we are, and maybe it's going to be easier for you to understand. Up. So is it the 2? Yeah. So here we are looking at the 10 versus the 2. So as we can see, we went negative before the COVID stuff. So we knew in 2019 that the after 11 years of growth, the US economy was starting to really slow, and the question was, when is the economic cycle going to reverse? After that, we had this big recovery here based on huge expectation. And since then, since the peak of last year in May, or April, May, we have been coming down. We have been coming down, in other words, because the market participants are a bit worried about, what's going to be the growth in 2023, okay, from let's say June 2023 onwards, and if we could go into a recession. So if we look at this yield curve, and if we look at the euro-dollar curve, the euro-dollar future contracts, as we can, so the euro-dollar is again for the newcomers, people that are just watching for the first time tonight on YouTube. Those are the euro-dollar tells you by how much market participants are expecting the Fed to rate hikes in that case. So if we compare today versus March 2022, for the time being, euro-dollar expected, market participants are expected the Fed fund futures to move by 36 bips. Okay, so 36 bips, that means, we are roughly halfway between 25 and 50. In other words, we get like a 60-70% chance that we're going to have 50 bips. If you look at by how much we're going to be moving in this cycle, we're going to be moving by 2%. But more interestingly, going forward after 2023, you can see that we are pricing 97.73, but then we start to go up again. Okay, so that is up, 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 and up, meaning that after December 2023, which is here, we are expecting the Fed to tighten again. And you don't tighten if you do, no, sorry, not to tighten, to loosen again. So yields will be coming down. So in other words, market participants here, when euro-dollar comes down, is because mostly because of inflation. Okay, so the central banks, the Fed, needs to tighten because there is too much inflation. Then the risk is you're going to have stagflation, and you need to act because you have less growth. And as you have less growth, you are cutting rates again. And this is why from December 2023, expectations are for the Fed to be cutting rates again. Okay, so in terms of catalysts, what do we have? We have now roughly 2 years of expectation of a cycle. Then question mark is what's going to happen next, where growth in 2024 is expected to be lower. But if the Fed starts to tighten, to loosen, sorry. That means, in other words, you are coming into a potential recession. Okay, so those are the catalysts that I think are keys. Always the catalyst, which is always the same, which is more about, you know, the structure of the market and how the, if you're not familiar, you will find a ton of webinars of research about, you know, gamma hedging, delta hedging, and how the positioning has been with options over the recent years. So looking at when are those options expiring, mostly on the third Friday of any single month. So in April, because we got Easter, that's going to be here. And then, you know, the Friday here, the Friday here. So this is for the options, for the futures, for the stocks. And you should be looking at the Tuesday, or let's say the Wednesday for the VIX here. Okay, so this is for the third Wednesday of the month. So those are the simple catalysts that you should be looking at, that some of the stuff that will be in your calendar. The beauty of a market, the beauty of trading, there's always the unexpected, and the unexpected, as we've seen this week, is with the Ukraine, Russia is a pure example. Having said that, you know, there has been a trend in the overall market. Before that, I think it was Damien asking about options trading. So here, I wanted, so I prepared this webinar, some part of this webinar at the start of this week, before the whole volatility spike. So looking at the options trading, the new Eldorado. Why I'm asking these questions is here, you have the, this is not a stock here. This is what I've done is I've been looking at the Google trend, and I've just put, you know, options trading. As you can see, when we had the peak of COVID, we had the peak of options trading. But since then, options trading for the last couple of years has been extremely strong. And we know that many retail traders went into options trading. So here in that chart, you see, so this chart is coming from quartz.com. And this is an interesting one where in pink, you get the average quarterly notional US options. And in blue, this is for stocks. And since last year, we have been seeing more options traded than stocks. Okay, so when I started, you know, trading, it was mostly about stocks. And let's say from 2016 onwards, the market was more and more driven by options. And as I explained during different webinars, is with the launch in 2016 or 2017 of the CBOE from weekly options, market was more and more driven by options. Since 2019, you get the beauty on top of it of many retail traders, many retail brokers, lowering the price of the commissions of trading, or even for free for stocks, or even for options. So suddenly, to get access to trading, it cost absolutely nothing. And the beauty of options, it gives you what? It gives you leverage. So as we can see here, in 2021, the volume versus any single other year is always going higher and higher. So from one year to another, it goes up and up and up. So in other words, if you trade the cash, if you trade stocks, if you trade CFDs, you need to be looking at options. So why people are using these options? So if you are trading in the US, if you are watching it today or watching it later on YouTube, if you are in the US, you, as an investor in the US, you only get 2 times leverage overnight. And if you're trading intraday, you get 4 times leverage, okay? Now, with options, obviously, options offer leverage. So everything that I put on that slide, and we're going to be discussing, is based on my experience as trading educator, okay? When I joined my previous trading education company in 2014, I had absolutely no idea about this industry of retail trading, okay? So it was really new to me. And at that time, when I joined that company, mostly what brokers and educators were pushing for were big leverage, and big leverage mostly through FX, because retail traders will be starting with FX, losing a ton. What retail traders will be doing now is they will be starting with trading crypto with huge leverage and losing a ton. But where I help people over the years is to work about, limiting your leverage and concentration. So even if it's not flashy, it does work. Over the recent years, many educators who advocate to be cautious with leverage are now pushing to do options. Okay. And again, why they want you to do options is because it gives you huge leverage. So if you want to talk to a US retail trader and you say you want to be making big returns, but you have limited leverage with stocks, what you do is you push them to do options. So this is what has been happening, and this is why so many brokers and educators will push you and advise you to do options. So the beauty of option, as we discussed just before that call, that subject, is there are many ways to structure the trade. And that means for many retail traders, it looks very compelling, because you will say, oh, you can do a call spread, you can do a put spread, you can do a call, you can do a covered call, you can do a condor, you can do whatever you want. There are going to be many strategies. So that sounds very appealing. But reality is, if you don't understand your concentration and leverage, you're going to be losing money. Another part that is important with options trading 101 is don't sell options naked. Okay. Only if you are very advanced in your education and as a trader, don't sell options. I've seen too many retail professionals get burned. So be careful on this. Then you get the execution risk that I discussed in one of my YouTube videos. But as I said before, really the part that is important in the component of the options are the Greeks. Okay, so the Greeks, the delta, the gamma, when it is expiring, and what is the implied volatility. The thing with the implied volatility, it affects very much a lot if implied volatility that is priced is at 30% or at 20%, because at 30% your premium is much higher, obviously, that is at 20%. So that means what retail traders are completely missing is they don't understand that when they buy a call or when they buy a put at 30%, it needs to be to move much more than if the implied volatility that they pay is at 20%. So this is why very often retail traders will be losing money. And finally, when you go long options, you can be assigned options. So what's going to happen is you're going to be buying, let's say, a call 100 on the stock is at 98, it expires on tomorrow, and the stock close at 101, you'll be assigned the stock on Monday. Okay, and suddenly you need to have decent money on your account, but because you're using leverage, you don't have that money. So this is what has been happening for many retail traders, and this is why you have very often moves that are happening just after the expiry. Trust me, and maybe I'm repeating myself, these days I'm seeing too many people coming to me and that are suffering from losing money only trading options. I know that some educators are telling you this is the beauty, this is perfect. Trust me, that just doesn't work like this. Why they are pushing it for? They are pushing here. This is an example with Interactive Broker. I'm using Interactive Broker. I think Interactive Broker is a good broker. Okay, but I'm just giving you the numbers of the contracts that they have been doing over the recent years. As you can see, in 2020, they increased the volumes of contract by 67%. If you look at 3Q 2021 versus 2020, up 34%. So that is from the 10K that I went to pick on the SEC website. But this is why, brokers, educators are telling you need to be doing options. It's just not because you're going to be making money. You are the people that are going to be losing money out of it. So here I'm taking some some funny example of, some webinars that I'm seeing and YouTubers, selling options for income, 1,500 a week, an option strategy that can return 100% overnight, generate 20% return on your investment with this option strategy, how to make awesome using calendar spread, plus 400% return trading JP Morgan options. You're going to have tons of those webinars, of those strategies where you're supposed to be making a ton. We know how it ends, which is, most retail traders these days, they will be putting between 10% to 100% of their capital into one ID on one premium. Okay, so let's say you get, let's say $500. What they're going to do is they're going to do putting $500 for a call on Tesla for tomorrow. Okay, but what is more worrying is when we see people and educators that are still pushing for even 10% of your NAV. And when I say 10% of your NAV, let me give you an example. So if you get 100% concentration, it's more or less being in a casino. If you do 10% of your NAV and you get 5 trades that are going badly, that means what? That means you're down 50%. So in other words, if you start with a capital of $25,000 and you put 10% of premium on one position, okay? So you say, I got $25,000. I'm going to be putting $2,500 worth of, let's say, buying calls on the SPY, okay? Let's say you're going to have, and that happens because that happens to anyone, is you're going to have 3 to 5 IDs that goes badly because you start and and those 3 to 5 IDs are going badly. In other words, you lose $2,500 times 4. So you lose $10,000. So you down 40% on your portfolio. So I think what is the fallacy here is to make people believe that you can have 10% of your portfolio in one ID. Because in other words, if you put 10% and if you do options, when you wrong with options, that means very quickly you're going to be offside. And with the theta, you're going to be, sorry for my English, piecing away the premium. Okay. So when you have 10% concentration in one single position and you use 10% stop loss, the way you should do it, your worst case scenario is 1% of your NAV. Okay. So if I put $2,500 on one position and I say, I don't want to be losing 10% of it, I'm going to be losing $250. Okay. But if I do $2,500 worth of premium, we know that when options go, if you get a call spread and you say, I'm going to be by, my call spread is 60 to 80 because I think there is this catalyst, which let's say the earnings. If the stocks opens on the earnings at 50, it's never going to recover and going to 60 and 80. So first, you're going to be so out of the money that it doesn't matter that this is a call spread. You're going to be losing 70 to 80%. Plus, with the theta, quickly it's going to go to 0. So what happens is and I've seen it. I'm seeing it these days when I get mentees that come at me and say, look, this is my track record. This is what has been happening. Okay. And versus that, we have the fallacy of saying, oh, you can be making 100% return. So here, this is an example where I want to show you what is the best strategy. If you tell me my expected return is 100%, / you look later on and you can see that you're going to be losing 50%. So that's for the investor A. What is the best interest? What is the best strategy? A, making 100%, losing 50%, or the B that is making 15% with a 5% downside. If you just do a Sharpe ratio, you can see that the Sharpe ratio of B or the adjusted risk return is much better from the investor B. And in other words, if you do 15% times 7, okay, so that gives you minus 35%. So don't get fooled by those stupid returns that people are telling you, you're going to be making X, Y, you should be putting 10% of your premium. I've seen that. I'm pretty upset because I've seen so many people coming at me these days with those losing trades. So from my experience, again, and I trust me, this is true. 90% of the people that have been doing this strategy, maybe they're going to have a good run first, but then in the long run, they lose money. Why? Because the reality is that it's not because you're using leverage by doing options that you have any strategy, that you have a process. It's not very different that, 10 years ago, where instead of doing options, you were probably doing 5 to 10 times leverage. So they are to concentrate with 10% NAV on one premium on one ID. So don't hide with things like, the Kelly criterion and those things. I've seen it again. This is completely wrong. I have people coming at me and saying, look, Greg, it doesn't matter. You should be only looking at realized P&L. What about your non-realized P&L? So they come to you, they give you some spreadsheet and say, look, my realized P&L is X. Then I look at their NAV, and the NAV is 20, 30% lower because actually they have so many losing trades. So be very careful on what you have. Read these slides again. And really what matters is not only the winners versus the losers, okay? Which is, your hit ratio, because you can have a good hit ratio, but what is very important is what is the average winners versus the average losers. So again, from my experience, people come and say, look, Greg, I have a 57, 60, 70 hit ratio, but I'm losing money. Guess what? Because you're winning, your average loser is probably 1.5 to 2 times bigger than your average winner. So those are the things that I'm pretty upset these days. I know it's something that people go for. They are, in other words, retail traders get very easily fascinated and think that, there is a magic formula that you can do, some funny structure with options. It's just not true. That will be too simple. So, okay, so that was me being upset. What about me helping you if I can? So I can help you with the trading community. So trading community is nice traders that put the IDs, that put struggles, that put, risk management. So that's something that I'm building, that we are building, that is where people that have been doing the 4x4 or the mentoring have access to. So the 4x4 video series, it's something that I built based on my 20 years experience on a long short product, and as well as a next mentor of another company where I knew where people were struggling. So you're gonna have access to 40 plus videos, 50 Excel spreadsheets. And then if you are a more advanced trader and you need help and you think that I can help, maybe that's gonna happen. That's a lot of if. Doing the mentoring. So this is one-on-one sessions that we do on Zoom. We do 12 sessions over 3 to 5 months. We go across the quantitative analysis, qualitative analysis, macro analysis, risk management, options, across asset classes. So that's something that I enjoy and I think works pretty well. This is it for today. So Michel, let me go back to your question. Can you look at some example of short-term day trade you made recently and you're thinking behind it? Yeah, I've been doing, I've been more short-term these days. So I can give you, today I've done some short-term and, and end up being flat on the day. I had some market trades in the morning being short some French banks, for instance, and then I lost being short on some renewables in Spain. As I said, the swings are so big that if you get it wrong, you need to cut it quickly. I think what happens, and I said that a couple of weeks ago, I reduced massively my size. So when you have 10% move on the day, when or 7% on the Nasdaq, that means you get many stocks that are moving 10% plus. So if you look, as I don't know if I said, but I was long Twitter and Facebook. I closed both of it. So today, between the morning and the afternoon, that's a 10% move. So you just need to adjust your size, and you'll be reducing your time frame. So it doesn't really matter which time frame you're using. I'm fine with any time frame, as long as you get a process and as long as you get a risk management. When you trade short term, obviously you can't have a 10% hard stop loss. Okay, you can't say, if I buy Twitter in the morning, I'm going to be using a 10% stop loss. You need to identify something that is going to give you, 1, 2, let's say 2% stop loss, because you're hoping to be making 6% on the day. So the risk reward still needs to be 2 to 3 times. But obviously, the daily move, the ATR on the day, is going to be normally much smaller than the ATR weekly or monthly. So you need to adjust those things. And that's, I think that is the most important thing, is not to be glued with, I'm going to have this stop loss, which is always 7, 8% or X in terms of money. It's more, you get the setup, you get the different time frame. That means you need to adjust as well your stop loss. So in a market like this one, there are many more opportunities, obviously actively trading. Having said that, maybe I'm too old now. Normally those are the markets that I would have been making 5 years ago, 10 years ago. Literally, I would have been making a killing, and these days I don't have it. So maybe I'm getting older. Maybe it's different than before. I think one of the, sorry for my English, one of the fuck up has been that we go back to the old habit that I'm mostly trading Europe in the morning, obviously, and Europe, as the price action has been pretty shit recently, versus the US. There has been some decent volatility in a sense that we have been bouncing nicely. So it's always hard. It's like on one hand, you get one price action, and on the other hand, you get another price action, but everything is on the same screens. And to me, that has been a bit of a struggle. But Michal, to come back to your questions, if you look at short-term trading, that means you need to be looking at different time frames. So in the charts, in the technical analysis, we look mostly at daily because we are thinking, about 1 to 3 months. When you try it shorter term, as you can these days, you're obviously looking at 1 minute, 5 minutes, 15 minutes, 1 hour chart, because you're going to have some more signal. And everything with technical analysis, with price action, has to come hand in hand with volume. So you can't be talking about prices moving without looking at volumes. The struggle that I've had as well is the market is very not liquid. There is very poor liquidity. So I'm pretty good at reading the market when there is liquidity. And as I've been saying over the last week on Twitter, over the last month or so, during those webinars, is the liquidity is really, really bad. So you're going to have volume at the end of the day, but to trade the books, to trade the market depth is pretty complicated. So suddenly the liquidity is going to vanish. And that makes, and it doesn't matter that, you don't have necessarily to be trading millions and millions, but that makes the short-term trading, at least to me, in Europe harder. It's a bit less true in the US because you always get more liquidity in the US, but in Europe is harder. And even in the US, you're going to have some big moves on stocks. So if you trade stocks like Twitter, if you trade even stocks like Facebook, in the first 20 minutes, you're going to have, probably bid offer sometimes of 20, 30, 50 bips. So suddenly you can see the Twitter going from 33.50 to 33.90 in absolutely 1 minute because there is no volume. So that makes, I think, some of the trading short term pretty hard. Again, in hindsight, with the fact that I'm pretty not very good these days, but I'm happy to say that in terms of short term trading, I've not been very good because my view has been the market going lower. So on Twitter, you're going to see people telling you, "Oh, you buy the dips. I'm superhero. I'm buying the dips." But look at the big picture. We are at the same level that we were a couple of days ago, and we are 5-7% lower than we were a couple of weeks ago. Meaning that if you've been buying this dip, you probably have been killed all the time. Okay. I think that is it for today. Thank you for joining. As I said a couple of weeks ago, be careful. I gave you a warning. Very strong price action today. I think there is a possibility of the pain trade to be higher now because many people reduce exposure, gross and net, and really the garbage outperform. When I say the garbage is ARK of this world, and when it starts to outperform and nobody is in it, very often it pushes a bit higher. But fundamentally, as we discussed today, until we get better visibility from the 15th of March onwards, both because of the Fed and the options expiry, because for the time being we are running, gamma negative. The market has a tendency to go lower. So there is a bit of two different views, and this is why I'm probably not that helpful. I hope still that you're going to be better than me these days. I'm flat for the month, which is okay. Up for the year, but I think I should have done much better. If you get questions, if you get struggle, if you have good things to share, please share. If you like what you're watching today or what you're watching later on YouTube, give some positive feedback, and like that always help. And for those of you that are on the community, see you soon. We're going to be doing this trading community mentoring session probably one Saturday in 2 or 3 weeks. Okay, so midday for the ones for everyone from Europe, US, and Australia. So make sure that you get on some IDs, and we're going to be discussing all of those IDs together. Pedro, it was a pleasure. Talk to you soon. Be safe. And again, that was a bad day for Europe overall. Really, we don't necessarily care about the market, but we care about the market, but there are more important stuff. All the best. Thank you. See you soon.